So number three, we want to invest for the long run. And we break this down into a few different components.
Number one is we want to buy low and sell high over time.
And really what that means is, as Warren Buffett would say, we want to be fearful when others are greedy, and we want to be greedy when others are fearful. And unfortunately, most investors kind of do the opposite. And most investors will invest a lot of money and get really aggressive after the market's been going up for a long time. They say, oh, the market's doing well, let me get in now. And then unfortunately, that's usually right around the time when the market's about to turn back around and start to go down, right? And then on the flip side, after the market's been on a downward trend for a while, investors are saying, oh, the market's not good, the market's scary, I'm gonna get out. And unfortunately, they end up selling at the bottom, right? And we want to do the opposite. And over the long run, this done effectively will result in positive outcomes for our clients. Another aspect of investing for the long run is that valuations matter and revert to the mean or the average. And that doesn't necessarily tell us what's going to happen in the short term with different types of investments, but it does tell us if we're getting in at a time when prices are high or prices are low. And over the long run, it's very likely that valuations will impact your long run returns. Valuation is understanding the multiple on profits that we're paying for the stock market. As an example, that price to earnings ratio in the stock market is higher than 16 or 17, let's say closer to 20 or even higher than that. That means that we're buying in at a time when the stock market is relatively expensive. What we see is that buying in at a high price to earnings ratio very often results in lower returns over time, and buying at a historically low price to earnings ratio oftentimes results in a higher long-term return on your investment. So this isn't the only thing that we should consider when we make investment decisions, and it's not a foolproof concept, but it is something that's really critical, and we should always consider it when making investment decisions. Additionally, in investing for the long run, we want to make sure that we don't get enamored with the hot new fad of the day. And last, that markets go up over time. So there may be volatility, but the stock market is essentially just a collection of the biggest and best companies in the world that make and sell all the important things that we buy and consume on a day-to-day basis. And so as long as there's more people becoming more productive over time, the stock market will continue to go up. If you'd like to learn more about the concepts of valuation and mean reversion and how to utilize them in your investment process, we'll have a separate video discussing this in more depth and going into more detail about it.